Now, with world news. GameStop, where many shop to buy games, consoles, controllers, and more, has been making headlines recently due to its massive increase in stock price. Amateur and professional investors alike have been scrambling to make sense of this market anomaly, with fears and positive outlooks of the company's future clashing and having real monetary effects on the stock market. At first, the stock had made a meteoric rise in prices, but soon dropped closer to its previous value. Now it's making another push. A report by Nasdaq made on the 3rd of March dives deep into the financial issues surrounding the stock prices. Originally, the report calls the first surge a Reddit-driven pump and dump scheme. Now, with a new surge pushing up prices again, analysts are wondering about the causes and reasons behind this phenomenon. The report points to two possible explanations: the use of bots on social media to boost the price, and the departure of former CFO Jim Bell. To fact-check the first claim, our team looked at the original report on the bots published by Reuters. This report in turn analyzes research made by PyQ, which is an organization that researches social media risks. Aaron Barr, the co-founder of PyQ, told Reuters, "We saw clear patterns of artificial behavior across the other 4 social media platforms. When you think of organic content, it's variable in the day, variable day to day. It doesn't have the exact same pattern every day for a month. These bots would take advantage of the social proof principle of persuasion made more possible by the rise of social media. Simply put, the more people seen advocating for the stock, the more people follow." The next claim concerning the departure of CFO Jim Bell is confirmed through a press release made by GameStop on February 23rd. Nasdaq then moves to a discussion about the e-commerce transformation that GameStop is undertaking to not only stay afloat, but possibly make a comeback in the gaming market. They point to recent growth in online sales, especially during the holiday season where e-commerce made up 1/3 of the company's sales, according to this holiday sales report made by GameStop. Further, it is reported that GameStop has been slashing costs and streamlining activities by closing 11% of stores, mainly underperforming locations. Further analysis of the stock shows anomalies as well, according to Nasdaq. At the time the report was published, the stock was trading at 105 times its earning potential. All of these issues led to Nasdaq concluding that the GameStop stock is a poor buy and should be avoided. They further claim that the disparity between prices and earnings make the purchase hard to justify. Now, analysis of the author and Nasdaq itself is relevant to the understanding of the position taken in the article. The author credited is Will Ibenthon, an employee of The Motley Fool. The Motley Fool is a financial services and analysis company that offers a wide array of financial and investment media for users to enjoy and base decisions off of. The publication's About section reads, "The Motley Fool champions shareholder values and advocates tirelessly for the individual investor." While this does point to an investor-friendly take on stocks, a disclaimer at the end of the original article puts that into question. The author, while discussing the earnings of the share, points to Amazon as an example or alternative purchase of a good, profitable stock. The Motley Fool has the CEO of Whole Foods, an Amazon subsidiary, on its board of directors. Therefore, it is within the company's best interest to promote Amazon stock within its content, and possibly even downplay others to boost sales of their recommended stocks. This is further exacerbated by GameStop's gains in e-commerce, which puts it in direct competition with Amazon. Nasdaq itself is an electronic stock exchange company that also deals in stock technology and analysis. Therefore, with large market disruptions like GameStop, it may be within the company's best interest to attempt to retain stability and present the markets as more real-world representations of the company's value. Nasdaq is a publicly traded company, meaning that it has its own shareholders that must be satisfied as well. Our conclusion is that the article is a faithful representation of the GameStop Corporation, but the downplay of the stock's profitability and potential during this time could be due to author and/or publication bias, and should be met with scrutiny.